If you still believe a government bond, a bank balance, and a domestic index fund are enough to protect your family when the monetary order starts eating itself, then you are not investing. You are sleeping in a paper house and calling it a fortress. I have spent my life studying capital allocation, incentives, panic, leverage, and what happens when people mistake a long stretch of calm weather for a law of nature. The public always does the same thing near the edge of a regime change. It takes the instruments that worked in yesterday's system and assumes they will keep working in tomorrow's war. That is how wealth gets erased. Not in one cinematic collapse, not always in a single day. Sometimes it happens through inflation, sometimes through devaluation, sometimes through controls, freezes, capital gates, policy improvisation, or a long grinding destruction of purchasing power that looks civilized right up until the moment people realize their life savings buy much less freedom than they thought. I want you to understand the frame I use, because once you understand it, the rest of this becomes obvious. Most portfolios are built like beach houses. They look attractive in sunshine, they photograph well, they feel intelligent because they worked in a long, stable, dollar-centered boom. But a beach house is not where you want to be when the water rises, the wind changes direction, and the authorities begin deciding which doors still open. I do not build beach houses with my money. I build lifeboats. A lifeboat is not designed to impress the neighbors. It is designed to survive a system failure. It is built for the hour when paper claims are questioned, when liquidity becomes selective, when currency loses dignity. When governments discover that the fastest way to survive politically is to tax silently through inflation and control visibly through regulation. That is the hour most investors never prepare for, because the preparations feel boring, paranoid, or unglamorous right until they become priceless. So I want to walk you through the lifeboat I would build in a world where debt is too large, deficits are too casual, paper promises are too numerous, and geopolitics is no longer a side story, but a direct input into portfolio survival. I am not talking only about tanks and missiles. I am talking about capital war, currency war, trade war, debt war sanctions, asset freezes, payment rails turned into weapons, treasury markets that stop behaving like moral anchors, central banks that print because they must, politicians who call it stability, while they quietly dilute every saver in the country. You do not need a PhD to see this. You only need to stop confusing nominal numbers with real safety. That is the first trap. If your statement says you made money, but the currency in which the statement is measured lost purchasing power faster than your assets gained it, you did not get richer. You got lied to politely. That lie is everywhere. It is in retirement projections. It is in yield charts. It is in the way people talk about safe cash when the cash itself is shrinking. It is in the way investors celebrate a market index without asking what that index bought in real terms against hard assets, food, energy, shelter, or monetary alternatives. Most people do not lose wealth because they are stupid. They lose wealth because they measure with a broken ruler. When I look at a dangerous period, I do not start with excitement. I start with diagnosis. The diagnosis today is simple. The developed world, especially the United States, has grown addicted to debt. Finance normality. The fiscal machine spends more than it earns. The monetary machine absorbs what politics cannot discipline. The public is told this can continue because reserve currency status feels eternal when you have lived inside it long enough. Nothing in finance is eternal. Debt can grow beyond the point where honest servicing is politically unbearable. At that point, governments have only a handful of ways out. They can default openly, they can repress financially, they can inflate quietly, they can devalue in relative terms, they can push the cost into holders of paper claims and pretend no one was robbed because the numbers on the statement never went down. That last method is the favorite because it looks respectable. Inflation is the most elegant theft in finance, no broken glass, no masked robber, no dramatic announcement, just a steady shrinking of what your labor, your savings, and your prudence can command in the real world. That is why I never let myself think in nominal comfort. If the state is over-levered, if geopolitical tension is rising, if capital flows are being weaponized, if confidence in institutions is eroding, then the job is not to chase the prettiest return. The job is to get your family into a lifeboat before the deck tilts. A real lifeboat needs 4 things. It needs a hull that does not depend on someone else. As promised, it needs ballast that adjusts when inflation starts throwing the vessel around. It needs supplies stored in more than one jurisdiction, more than one currency, more than one economic climate, and it needs more than one engine, because one source of return is not diversification. It is dependency wearing a sophisticated suit. That is the whole structure. Let me start with the hull. The hull of a lifeboat is physical gold. I know many investors do not like hearing that because gold makes them uncomfortable. It produces no quarterly earnings call. It offers no CEO narrative. It does not flatter the modern mind, which prefers spreadsheets, dashboards, and promises wrapped in technology. Gold is rude. Gold simply sits there and refuses to depend on anyone. That is exactly why it matters. When I hold physical gold, I am not asking a bank to survive. I am not asking a government to stay disciplined. I am not asking a board of directors to act rationally. I am not asking a clearinghouse to function, a regulator to remain neutral, or a currency to preserve dignity. I am holding an asset with no counterparty risk and no printing press attached to it. That quality becomes very expensive during monetary stress. In peacetime, people mock what they do not immediately need. In wartime, they pay anything for what cannot be diluted. Study history long enough, and this pattern becomes impossible to ignore. When states overspend, when debts grow faster than productive capacity, when confidence weakens, when convertibility breaks, when policy becomes improvisation, hard monetary alternatives are re-rated violently. Not because they changed, because everything around them did. That is a crucial distinction. Gold does not need to become brilliant. Paper just needs to become questionable. Most portfolios I see treat gold like an eccentric side, holding the financial equivalent of a conversation piece. I do not think about it that way. In a dangerous regime, gold is not jewelry. It is monetary armor, not paper gold, not a derivative whose functioning depends on the very architecture you are trying to hedge. I mean the real thing held in a way that reduces intermediation risk. If the purpose is protection, you do not build that protection out of another promise. Now, I am not telling you to turn your entire life into a vault. That would be another form of emotional stupidity. A lifeboat is built by proportion, not by obsession, but I would much rather own a meaningful slice of something. No central bank can create with a keystroke than drown elegantly in assets, whose supply expands whenever policymakers panic. That brings me to the second part of the lifeboat. A hull alone does not save you in rough water. You need ballast. In an inflationary storm, that ballast is inflation, indexed sovereign bonds. This is where many investors get lazy. They hear the word bond and immediately file every bond into the same mental cabinet. That is sloppy thinking. A nominal bond and an inflation indexed bond are not the same creature. One promises fixed dollars. The other is designed to protect real purchasing power against the quiet sabotage of rising prices. That difference is everything when governments are cornered. A normal saver looks at a fixed coupon and feels calm. I look at it and ask a harder question. Calm measured against what? Against groceries, against rent, against healthcare, against energy, against the taxes you see and the taxes you do not, against what your money buys after a state has spent years financing deficits through dilution. If you do not ask that question, you are not being conservative, you are being superficial. Inflation. Index sovereign bonds matter because they give the safe portion of a portfolio a better mission. Instead of merely preserving nominal balance sheet appearance, they try to preserve real economic usefulness. In plain English, they are one of the few paper instruments that openly admit the ruler itself is moving. That honesty is rare. Again, I am not saying they are magic. Nothing is magic. I am saying they are better ballast than fixed paper in an environment where governments are incentivized to make fixed paper worth less in real terms. They help stabilize the vessel when the water itself has changed density. If you build a portfolio without that ballast, you are telling yourself a comforting story about income while ignoring the silent tax eating that income alive. Now we move to the third element of the lifeboat, and this is where ordinary investors usually fail because they stop at cosmetic diversification. Owning 40 American stocks is not real diversification. Owning a U.S. bond fund, a U.S. growth fund, and a U.S. dividend fund is not real diversification. Owning the same legal system, the same currency exposure, the same political risk, and the same monetary regime through different tickers is not diversification. It is concentration with better marketing. A real lifeboat carries supplies from more than one shore. That means meaningful exposure to assets outside a single country's balance sheet. It means non-use equities where valuations, demographics, and policy structures differ. It means commodities rooted in physical reality rather than financial narration. It means hard real assets in stable jurisdictions. It means some ownership that is not priced entirely through the continued supremacy of one empire. Currency. This is not ideology, it is arithmetic. Every reserve currency era teaches the same lesson. The citizens closest to the center of monetary power are usually the last to believe the center can weaken. They confuse familiarity with permanence. They confuse long dominance with permanent dominance. They confuse the convenience of the current system with the invincibility of the current system. That is a very expensive emotional error. I have watched people spread money across sectors and call themselves diversified while remaining fully trapped inside the same currency. The same legal reach, the same policy mistakes, and the same central banking experiment. That is not a lifeboat. That is rearranging furniture inside the cabin. Real diversification feels less elegant because it forces you to admit your home system is not sacred. That admission is psychologically difficult, especially for investors who built their identity around national financial dominance. But your portfolio is not a patriotism test. It is a survival system. If capital controls intensify, if sanctions multiply, if trade fragmentation deepens, if reserve flows change direction, assets tied too tightly to one national balance sheet become more fragile than their owners expect. I do not want fragility masquerading as prudence. So I want supplies in different climates. I want some assets that benefit if energy tightens. I want some assets rooted in raw materials the physical world still needs. I want exposure to productive businesses not living entirely off one central bank's credibility. I want ownership of things that remain useful even when policymakers start improvising. And yes, I also take seriously the logic behind globally recognized tangible assets that sit outside conventional financial correlation. Fine art is not for everyone, and I would never turn it into mass advice. But the principle matters. Globally desired, tangible, scarce, culturally recognized assets often behave differently from ordinary paper when monetary regimes start shaking. The lesson is not that everyone should become a collector. The lesson is that tangibility and global recognizability have value when trust thins. That is the third element of the lifeboat. Now we reach the fourth. And this is where the structure becomes truly powerful. A good lifeboat does not rely on one engine. Most investors think they are diversified because they own many things. But many things can still be one bet if they all rise and fall for the same reason. The test is not quantity. The test is correlation under stress. That is why I care so much about uncorrelated return streams. When fear spikes, when liquidity vanishes, when policy shocks hit, what do your assets actually do relative to one another? Do they all sync together? Do they all depend on the same macro story, the same discount rate, the same policy rescue, the same credit spread, the same investor appetite for risk? If they do, then your portfolio has one engine painted in 15 colors. That is not resilience. Resilience comes from building a structure in which different assets respond to different environments. Inflation, disinflation, growth, recession, monetary panic, currency weakness, commodity shocks, regional divergence. I want my return streams to come from different biological organs, not from clones wearing different ties. This is the mistake the public keeps making. It optimizes for what looked smart in the last cycle and ignores the possibility that the next cycle will attack from another direction. A real lifeboat assumes the wave can come from anywhere. That means one part protects against paper debasement, one part protects against inflation in explicit mathematical terms. One part protects against national concentration and currency concentration. One part protects against the failure of correlation assumptions. When you combine those layers, something changes psychologically as well as financially. You stop needing perfect predictions. That is one of the biggest advantages of a serious portfolio structure. It reduces the ego required to survive. The amateur wants to be right about one grand forecast. The professional wants to remain solvent across several ugly forecasts, including the ones no one can describe neatly in advance. That is a much more durable ambition. Let me push this harder. Because the psychological damage of the current era runs deeper than most people appreciate. People have been trained to believe liquidity is a permanent feature of modern life. They think they can always sell, always rotate, always rebalance, always access, always transfer. They think the system is a utility. They do not appreciate how quickly the system becomes selective when stress gets political. That is why I am suspicious of assets that look liquid in calm conditions, but depend on gates, approval, market, making generosity, or policy tolerance. When panic arrives, a lifeboat is not the place for fake doors. This is also why nominal yield can be a trap. A yield figure by itself tells you almost nothing. I want to know what risk bought that yield, what inflation can do to it, what policy can do to it, what devaluation can do to it, what capital controls can do to it, what correlation can do to it, and whether the buyer understands the difference between being paid and being compensated. Many people do not. They chase income because it feels adult. They collect paper promises because the statements look neat. They think the presence of a coupon means the absence of danger. Then a regime shift teaches them that a promise can remain intact on paper while dying in real life. This is why I keep returning to the same contrast. Paper safety versus real safety. Nominal stability versus purchasing. Power stability. Domestic familiarity versus global resilience. One engine versus many engines. Beach house versus lifeboat. Once you internalize those contrasts, your behavior changes. You stop obsessing over whether some fashionable stock will beat estimates next quarter. You stop treating your cash balance like a sacred object when the currency is weakening. You stop confusing domestic concentration with confidence. You stop measuring success only in the local unit of account. And most importantly, you stop waiting for official permission to protect yourself. That last part matters more than most people realize. The window to prepare is always wider before the storm than during it, before a serious crisis. Protection feels optional. During a serious crisis, it becomes expensive, restricted, or unavailable. That is why the public is almost always late. It waits for proof. It wants the authorities to say the quiet part out loud. It wants headlines dramatic enough to justify action. By then, the easy moves are gone. I do not need a siren to smell smoke. I have seen enough cycles to know that fragility announces itself long before the break. It shows up in debt that grows faster than productive output, in deficits normalized as lifestyle, in central banks boxed between inflation, unemployment, asset prices, and political pressure in foreign actors diversifying away from your paper, in the weaponization of payments, reserves, and market access, in the casual assumption that these are isolated incidents instead of parts of one system change. That is how a financial order weakens. First the discipline goes, then the honesty goes, then the purchasing power goes, then the confidence goes. Then the crowd discovers the difference between owning a claim and owning something real. I would rather discover that difference early. So if I were speaking to an ordinary family trying to defend the fruits of decades of work, I would not give them a thrilling speech. I would give them a hard instruction. Stop building a life that assumes the ruler never changes. Stop calling yourself conservative because you own familiar paper. Stop believing your domestic system will always be the cleanest shirt in the dirty laundry. Stop measuring your wealth only inside the frame that governments can alter. And start asking the only question that matters in a dangerous transition. If the system turns hostile, what in my portfolio still floats? That question strips away an enormous amount of nonsense. A luxury stock story does not answer it. A clever macro thread on the internet does not answer it. A large checking balance does not answer it. A fixed coupon alone does not answer it. A national success narrative does not answer it. A real answer looks more like this. Some of your wealth sits in monetary armor that cannot be printed. Some of it sits in inflation, linked paper designed to preserve real value rather than flattering nominal illusions. Some of it is spread across geographies, currencies, commodities, and hard assets that do not all kneel before the same policy regime. And the structure as a whole is built from return streams that do not all fail for the same reason at the same time. That is not fear. That is disciplined refusal to be trapped. Now, I want to say something uncomfortable. Most people resist this kind of preparation, not because it is logically weak, but because it is socially awkward. It forces you to live one layer beneath consensus. It forces you to admit that authorities can become unreliable stewards. It forces you to hold assets that look unfashionable in boom periods. It forces you to accept that the crowd's definition of safety is often a lagging indicator of danger. That social discomfort is the price of independence. I have paid it many times in markets. I will gladly pay it again because I know the alternative. The alternative is to think like the crowd, position like the crowd, and then act shocked when the crowd discovers all at once that its assumptions were built on policy conditions. monetary conditions and geopolitical conditions that no longer exist. I am not interested in being shocked on schedule. I am interested in staying afloat. And I want you to understand that this is not only a portfolio issue, it is a dignity issue. Money is not just a scoreboard properly handled. Money is stored choice. It is stored refusal power. It is the ability to say no to desperation, no to bad timing, no to predatory financing, no to the humiliations that come when paper wealth evaporates, exactly when life becomes expensive. That is why I take monetary protection personally. When inflation robs you, it is not merely reducing numbers. It is shrinking your future options. When devaluation strikes, it is not merely a chart move. It is a transfer of control away from savers. When capital systems harden, it is not merely policy. It is a narrowing of individual room to maneuver. And when people spend 40 years building a nest egg, only to discover it was a beach house in disguise, something far deeper than money is lost. Confidence is lost. Time is lost. Self-respect is damaged. The illusion of safety turns into bitterness. I do not want that ending. So I return to the lifeboat. The hull is real monetary armor. The ballast is explicit inflation protection. The supplies are spread across shores, climates, currencies, and physical realities. The engines are uncorrelated, so one failure does not become total failure. Every serious portfolio I admire in one form or another respects those principles, not always with the same instruments, not always with the same percentages, but always with the same underlying intelligence. Survive the regime change first, then worry about elegance. That sequencing matters. The public often does the reverse. It worries about elegance first. It wants optimization before robustness. It wants maximum efficiency in a world that may soon punish efficiency and reward redundancy. It wants concentration because concentration made heroes in a rising tide. Then the tide changes and redundancy suddenly looks like genius. Redundancy is not inefficiency in a dangerous world. It is mercy. I will say it even more plainly. If you build your financial life entirely around one currency, one legal regime, one set of correlations, one story about peace, one story about disinflation, and one story about institutional competence, then you do not have a portfolio. You have a prayer. Prayer is not an asset class. I prefer structure. And structure begins with accepting that the rules can change faster than the public expects. They have changed before. They will change again. The investors who survive are not always the smartest. Often they are simply the least sentimental about paper promises and the most serious about real purchasing power. That is the test I use. Not whether an asset looked brilliant in the last expansion, not whether it makes me feel modern, not whether it flatters a spreadsheet, but whether it helps the lifeboat float when the sea stops behaving. That is why I keep meaningful respect for gold. That is why I insist on inflation protection in the safe portion of a portfolio. That is why I want global hard assets and genuine diversification rather than patriotic concentration disguised as prudence. That is why I care about uncorrelated streams of return more than fashionable narratives. And that is why I'm telling you this before the emergency, not during it. Preparation always sounds excessive until it becomes inadequate. The crowd always thinks there will be time. Time is the one asset no central bank can print back for you. You can rebuild a portfolio, you can change a manager, you can alter an asset mix, but if you lose years because you waited for official confirmation of what the balance sheet, the incentives, the geopolitics, and the monetary arithmetic were already screaming, you do not get those years back. That is the final test I would leave you with. Look at every dollar you own and ask yourself a brutal question. Is this piece of my portfolio part of a lifeboat? Or is it part of the beach house? Does it float when paper weakens? Does it hold when inflation lies? Does it survive when borders harden? Does it still work when the crowd discovers that liquidity, convertibility, and safety were conditional? Not permanent. If the honest answer is no, then do not hide behind habit. Do not hide behind patriotism. Do not hide behind what worked from 2009 to yesterday. Do not hide behind the comfort of familiar tickers and fixed statements. Act while the water is still below the floorboards, because when a financial order begins to fracture, the people who come through it with wealth intact are not the ones who talked the most, traded the most, or predicted every headline. They are the ones who built for survival before survival became fashionable. That is what I would do. That is what I respect. And that is the choice in front of you now. You can keep decorating the beach house, or you can start building the lifeboat.